Good morning, Tina Mitchell here with your Mortgage Minutes. I wanted to talk today about interest rates because it is definitely a hot topic, and I wanted to break it down and also give you some clarification what's happening and how it all works. So the central bank announced that it's taking down its benchmark overnight lending rate from a target of 1.75 to 2%, and this is previously lowering it from a 2% to a 2.5%. Now, this rate is what banks are using to lend money to each other, typically overnight, and it's known as the Fed funds rate, similar to how the Fed discount rate works, and that's what banks are borrowing from the Fed. It is to be used to control the supply of available funds. So how this affects the prime rate, the US prime rate, typically the calculation is 3% over the current Fed's fund rate. So the current Fed's fund rate right now today is at 2.25%. So if you add 3% to that, that's what we have our current US prime rate at 5.25%. So when the feds make an adjustment to the Fed funds rate, that directly is tied to the US prime rate. Now, what the prime rate affects is your short-term borrowing capability. So that would affect your credit cards, your car loans, your home equity line of credit. The Fed's job is to manage inflation and to maintain a balanced market. So if they feel that there's too much confidence in the economy, then they're going to go ahead and increase the Fed funds rate, which is going to increase the prime rate and make it more expensive for short-term lending, borrowing for the consumers. Now, if there is lack of consumer confidence, obviously some things that are going on right now in the US economy, then they're going to lower the Fed funds rate, which is going to directly affect the prime rate, which is what consumers are paying to borrow money for short-term lending in hopes to stimulate the economy. Now, here's where there's a lot of confusion, is that when the feds adjust the Fed funds rate, which is directly tied to the US prime rate, a misconception is mortgage interest rates are going to follow that, and that would not be an accurate statement. Mortgage rates are based on how the Fannie Mae 30-year bond is trading. Sometimes the Fannie Mae, the bond market will favor well when the feds are lowering the prime, and the bond market will increase in trading, which means mortgage rates will go down. Sometimes with what the feds are doing to the Fed funds rate, which affects the US prime rate, sometime that will actually be a negative impact to the bond market, which means that mortgage interest rates will be increasing. Now, typically, the bond markets are going to work opposite of the stock market. So if there's consumer confidence, the investors are investing in the stock market for a higher return, and mortgage or bonds are suffering. Now, if there's lack of consumer confidence, that's good for mortgage bonds. Mortgage bonds are trading higher. The Fannie Mae 30-year bond is what mortgage rates are tied to, and then if they're trading higher, mortgage rates go down. So I want to give you just a little bit of a visual here so you can see what I'm talking about, and I give you a little bit more idea of what's happening. So this is just a chart that compares the US prime rate, and then if we look here, the 30-year fixed mortgage interest rate. So if we just go here, back in January of 2008 is when the feds decided to start lowering the Fed funds rate, which again, the US prime rate is directly tied to that. And as you can see, it consistently dropped every single month. It was crazy what was happening here with the prime rate. Now, what's important to look at is the 30-year fixed rate. As you can see, as the prime was lowering, the 30-year fixed was going up. Why? Because what the feds were doing was actually strengthen the economy. So consumers were spending more money. They were more confident in what was happening in the market. So they were investing in the stock market, and the bond market suffered because of it. When the bond market suffers, being that mortgage rates are directly tied to the Fannie Mae 30-year bond, mortgage interest rates went up. Now, then you saw mortgage interest rates go down here, and so you can see there's a lot more movement in mortgage interest rates than what you see in the Fed's prime rate. Here, when we get to January of 2009, they decided now that they were going to stop lowering the Fed funds rate, which directly the prime is connected to that. Again, 3% over typically where the Fed funds rate is at. And then all the way here, there was no adjustment in the prime rate. But you can see lots of activity if you look at the green line here for mortgage interest rates. Now, just to let you know what's going on with mortgage interest rates, which is another example that it's not directly tied to what the Fed is doing with the Fed funds rate, which the US prime rate is directly tied to. Obviously, in starting the conversation, they are lowering that benchmark, and so most likely we'll see the Fed fund rate go down, which means the prime rate is going to go down. Well, mortgage interest rates have actually gone up. On an average, the mortgage interest rates were around 3.5%. They're closer to about 3.75% right now today. Mortgage rates change again every day. The bond markets adjust up and down every day, just like the stock market does. So hopefully today's Mortgage Minutes helps to give clarification on what's happening with rates. Mainly what's happening with the Fed funds rate and how that's directly tied to the US prime rate, which affects you as a consumer in your short-term lending, and what's happening with mortgage rates, and the clarification that they are not directly tied to the US prime rate. Please reach out to me if there's any assistance that I can be in your mortgage needs. It's still a great time to refinance your mortgage. It's an amazing time to purchase, to get out to the market. You can reach me at my contact information that will be listed in where you found this video. Make it an inspiring day, and I look forward to hopefully assisting with you with your mortgage needs in the near future. Thank you.